All right, let's just dive right into it, shall we? Welcome back to The Explainer, where we take these massive and incredibly complex financial puzzles and break them down into something you can actually use. Today, we're putting a literal titan of the market under the microscope. We are running Microsoft through what I like to call the ultimate valuation gauntlet. We're talking 21 different financial models. We're going to dig up 7 hidden red flags buried deep, and I mean deeply, in the financial footnotes. Plus, we're grading this stock using the exact frameworks of legendary investors like Warren Buffett, Peter Lynch, and Ben Graham. By the end of this, you're going to know exactly what the numbers are screaming, and honestly, why the mainstream financial media might be completely ignoring the real story here.
Because here's the thing, Wall Street, they absolutely love a good revenue beat. Every single quarter, it's a huge celebration. But you and I both know we don't care about surface-level headline beats today. We want to know what is actually happening under the hood. Is Microsoft a true generational buy right now? Or is this massive wave of AI hype just masking a giant cash flow bonfire? That is the central mystery we're solving today by looking at the hard, unfiltered data. Now, really quick before we rip into the guts of their 10K report, let's cover our legal basis. This is an educational case study and quantitative analysis. It's for informational purposes only, so no, this is not financial advice, investment recommendations, or an offer to buy or sell securities. And as always, past performance does not guarantee future results. Make sure you consult a licensed financial advisor before making any of your own investment moves. Okay, legal stuff out of the way, let's get to work. $3.68 trillion. Just let that number sink in for a second. That is Microsoft's market cap, with the stock trading at roughly $495 a share. I mean, it's an absolute beast. It's literally larger than the GDP of a lot of developed nations. But look, the question today isn't whether Microsoft is big. We all know it's big. The question is it actually worth that specific price tag right now? Which brings us to Section 1, finding the magic number. To cut through all the daily market noise, we went ahead and ran 21 distinct valuation models across 5 different categories. Basically, we're looking for the mathematical center of gravity here, that ultimate magic number. So let's break this down. First up, looking at cash flows, our standard discounted cash flow model, and we're using a 10% weighted average cost of capital and a 3.5% terminal growth rate here. That spits out an intrinsic value somewhere between $530 and $580. And the unlevered free cash flow completely backs that up. But hey, notice what's missing from this equation. Models looking at dividends and book value. Honestly, those are basically useless for Microsoft. The dividend yield is barely scraping 1%, and the price-to-book ratio is over 8. You don't buy this stock for the dividend check, right? You buy it for the explosive growth. When we run comparables against heavyweights like Apple and Amazon, we land in the $470 to $550 range. So when we average the whole shebang out, and yes, that includes the embedded call option of all this AI growth, our magic number weighted average lands right between $530 and $555 per share. Compare that to the current price of around $495. So what does this all mean? Well, it brings us to a pretty clear mathematical conclusion. Based purely on the hard math of those 21 models, Microsoft is currently sitting at about 7 to 12% undervalued. Now, let's be real for a second. That is not some screaming back-up-the-truck once-in-a-lifetime bargain. But it is cheap relative to what its future cash flows are telling us it should be worth. However, as we know, the math is only half the story. We have to look at the actual quality of those cash flows. And that leads perfectly into Section 2, red flags versus green flags. This is our footnotes investigation. This is where the real digging kicks in. Listen, I don't care about a minor earnings per share miss. What I really care about are what I call the media blackout flags. These are the complex, gritty details buried so deep in the footnotes that the financial press just completely ignores them because, well, they don't fit into a neat 5-second soundbite on TV. Let's look at the red flags first, and then we'll balance the scales with the green flags. Right out of the gate, here is red flag number 1. And guys, it is an absolute monster. Look at how much that one slice is dominating things. Capital expenditures, meaning the actual cold, hard cash they are spending on physical assets and infrastructure, is eating up a staggering 63% of their operating cash flow. They're spending over $116 billion on infrastructure. Now, I know Wall Street loves to stand up and cheer for AI spending, but let's be pragmatic here. If that $116 billion massive spend doesn't yield equally massive, tangible revenue down the road, it's just a giant money pit. And digging into the footnotes reveals 6 more red flags. Number 2, their gaming segment is actually in decline.
Xbox revenue is falling, and that massive Activision acquisition is showing some real impairment risks. Number 3, accounts receivable just ballooned by $12.7 billion. What does that mean? It means they're getting paid a lot slower. Number 4, R&D efficiency is shrinking. They're literally having to spend more money just to maintain the exact same revenue growth. Number 5, and this one is incredibly alarming to me. They have a 50% free cash flow conversion rate. Basically, on paper, their net income looks amazing at $134 billion, but the real, actual, spendable free cash flow? Only $67 billion. It's like making $100 but only getting to keep 50. Number 6 is the goodwill risk from all these massive acquisitions, which could easily lead to some nasty write-downs. And number 7, insider ownership is essentially zero. It seems like the people actually running the company prefer to keep their own cash safely in their own wallets. But we have to flip the coin here, because the media ignores the green flags just as much as the red ones. First up, their deferred revenue is actually growing faster than their sales. Specifically, commercial remaining performance obligations, which is basically guaranteed future contract money, is up 84%. I mean, that is literally guaranteed money in the bank. Second, they're actively buying back their own stock at prices below our intrinsic value estimate. That is just incredibly smart capital allocation. Add to that some really excellent tax optimization, a decreasing reliance on a few key suppliers, and an absolutely massive, completely unassailable AI patent portfolio. So yeah, the data under the hood is definitely mixed, but the underlying quality of this business, it's undeniable. All right, moving to Section 3, the Legends Scorecard. So, with the math showing the stock is slightly undervalued, but the footnotes showing some pretty dark storm clouds gathering, how do we actually settle this debate? Well, let's consult the ghosts of investing past and see exactly how the absolute legends would grade this stock today.
First up on the scorecard, we have Ben Graham, the godfather of value investing himself. If we plug Microsoft into the Graham number to find the absolute maximum price he would pay for perfect safety, we get $155. Considering it's trading around $495 right now, Graham gives us a very hard pass. Next, we bring in Peter Lynch, the classic growth at a reasonable price guy. He looks really closely at the PEG ratio. Microsoft is currently sitting at 1.53, which is way above his super strict 1.0 threshold. So Lynch, he's out too. But then we look at Warren Buffett. Now, the Oracle of Omaha cares a lot less about the immediate sticker price and way more about the competitive moat and the return on invested capital. Microsoft's ROIC is over 26%. That completely crushes his 15% threshold requirement. Plus, their net debt to EBITDA is a microscopic 0.64. Buffett has explicitly said he doesn't mind paying up for supreme quality. And his verdict? Buy or hold. He would absolutely love this cash machine.
Which brings us to Section 4, the final verdict and the moat. It's time to bring it all together. We've run the models, we've dug through the footnotes, and we've checked the Legends scorecards. The ultimate reason an investor like Buffett would confidently hold this stock, and honestly, the reason those intrinsic value models remain so incredibly strong, is the moat. Microsoft possesses all 5 sources of a classic economic moat. They have powerful intangibles, like that globally recognized brand. They have massive switching costs. I mean, once an enterprise is fully integrated into Windows and Office, trying to leave is a total logistical nightmare. They have network effects, immense cost advantages, and just unparalleled scale. And here is the absolutely crucial point. As Microsoft keeps layering artificial intelligence into Office and their Azure cloud platform, the difficulty for a client to switch to a competitor doesn't just increase, it becomes exponentially harder. That moat is wide and it is expanding by the minute. But, of course, this brings us to the nuance, the absolute linchpin of this entire valuation. It all hinges on one thing, the return on investment for AI. On one hand, we have the perfect AI outcome. If Azure successfully monetizes all these crazy new tools, the stock hits $600 easily, no sweat. The intrinsic value thesis holds up perfectly. But flip the coin to the CapEx trap. If that $116 billion in capital expenditure does not translate into real bottom-line revenue growth, their profit margins are going to compress severely. And suddenly, that nice 12% undervaluation flips on its head and the stock becomes 20% overvalued. Which leaves us with this final, incredibly vital question. Right now, Wall Street is fully pricing in that perfect AI outcome. The mathematical models are telling us to buy the dip because it technically looks cheap relative to the projected cash. But our deep dive into the footnotes, that 50% cash conversion, the massive scary CapEx spend, shows very real storm clouds on the horizon. So when you step back and look at this entire picture, what's your play? Are you betting on CEO Satya Nadella's proven ability to execute and monetize this tech? Or are you betting strictly on the absolute safety of the balance sheet? The numbers are all right here laid out for you, but the choice is ultimately yours. Use this explainer to do your own homework, stay skeptical out there, and I will see you in the next one.